everyone. Today we're going to go over self-funded health insurance policies versus your traditional fully insured policies. So let's dive in. Your traditional fully insured programs are the ones that you're most familiar with. These are the ones that you're getting maybe from your current broker, the ones where the rates are going to go up, there's no pre-existing conditions, and they're the most popular amongst plans that are offered to small group and mid-sized businesses amongst the U.S. The self-funded and level-funded health insurance policies are a little bit more complicated, but they allow you to take more control over your health insurance premium and the way that the benefits are structured. So we're going to dive into the differences right now. So my name again is Jeff Costello. I'm from groupbenefits.com. We've been featured in a variety of different publications, and we've talked about the importance of reviewing your level-funded self-insured options in many different articles online, which we can always share with you. And those are going to kind of dive into what I'm going to talk about in today's video. So your fully insured programs. Your fully insured programs are going to be options with many of your most popular carriers, whether it's a Blue Cross Blue Shield, a Cigna, UHC, and it's going to vary from state to state. But the way that it works on the fully insured programs are that if this is you, and you own your small business or you run the benefits for your company, you're boxed in with all of the other members that also have that carrier on the fully insured platform. So for example, let's pretend that your company has Blue Cross Blue Shield. Well, the rates are the rates. There's no loyalty discount just because you've been there for 10 years. There's no discount on whether you have 5 employees or 10 employees. Basically, the way that it works is if you're, let's say, 50 years old, your rate is going to be the rate of a 50-year-old. And maybe for the plan that you're on, that plan is $800 a month. Well, you're paying that $800 a month whether you're using the insurance a lot or not using the insurance at all. Again, you're boxed in, you're lumped in with all of Blue Cross Blue Shield's fully insured members. And so the way that it works is if you have no claims, but maybe another company down the street has a lot of claims, it all balances each other out. So you're paying that $800 rate for that 50-year-old regardless of your health. And again, there's many carriers that offer fully insured programs. Cigna might need a certain amount of eligible employees before they offer you a fully insured, but there's a lot of carriers out there. They all have their different underwriting requirements. And the same thing comes for level funded, right? So if we're looking at level funded is going to offer a lot of the same carriers. So these carriers will have products on both sides of the aisle. Now there's going to be some companies that may come into play that you may not have heard of, maybe like an Optimal Benefits, an Allied, or an Allstate. And those carriers are basically going to utilize some of these other networks to offer a self-funded or level-funded program to you. The way that these plans work is your rates, your premium, your benefits, everything like that, your future renewal increases are based slowly off your company. It has nothing to do with anyone else that may have those carriers. Again, your rates are strictly based off of you. A quick example on how it works for a fully insured program. So if you have a fully insured program, and let's say you run a construction business, you're lumped in with everyone else. The grocery stores, the pharmaceutical companies, the prescription companies, the truck driving companies. You're all lumped into whatever carrier that might be. So if the carrier collects $1 billion in premium, but they pay out $1.1 billion in claims, well then they're going to go to all of the members in that box in their fully insured programs, and they're raising the rates, right? So even if you didn't use the insurance, it's irrelevant. You're part of their total block of business, so you still get that rate increase. Now it's a little bit different on the level funded programs, because the level funded programs again are based slowly off you. Whereas again, the fully insured, you're lumped in with everyone. So I'm going to show you a quick case study, and this is a real life example of a group that we recently helped. They had Blue Cross Blue Shield, and they had offered 3 plans to their employees, and we showed them a level funded program with UHC. Now, again, UHC was just the most competitive here, but even Aetna and other carriers came in at a huge cost savings for this company. So in this example, right, they offered 3 plans. Their total monthly premium was about to be a little over $11,000. We got it down to $6,800. So a huge cost savings. Annually, they were going to be paying over $133,000 for their insurance premium. We got it down to $81,000. Now again, that's a huge cost savings, and you might be saying, well, what's the catch, right? Maybe the benefits are worse. So let's dive into how the benefits work. So this is their fully insured renewal. Again, they had Blue Cross Blue Shield. They offered 3 plans. They had a base plan where the deductible was $2,500 with your standard, $30 or $40, $50 or $60 copays, depending on, where the doctor fell into Blue Cross Blue Shield's network. They offered a direct access plan. This is a plan that also had out-of-network coverage. And then they offered another plan, a gold plan, with a slightly lower deductible if the doctor was a tier 1. Now you're going to notice that the out-of-pocket for the two plans were close to $9,000, and the one out-of-pocket was close to $6,000. And so we basically got them with UHC, and we kept that deductible at $2,500, slightly lowered their out-of-pocket to $8,000. The plan that had the $6,000 out-of-pocket was reduced down to $4,000. The deductible was reduced. We did have to include a $500 deductible here, as just UHC just could not compare apples to apples. And that's what you're going to find whenever you're comparing one insurance carrier to the next. It's never apples to apples. It's always apples to oranges. But even here, we're able to offer the people that had the gold plan that $1,350 deductible at $500 with a lower out-of-pocket limit. And that's where a majority of employees were. Majority of the employees on the Horizon plan were here with this gold plan. So again, they were going from $1,350, $2,500 deductible down to a $500 deductible. So they were going to be saving a ton of money. Their out-of-pocket limit came down. And so the benefits, again, were pretty comparable, if not better, in most areas. And so even the lab and x-rays were better, right? They're covered at 100%. Urgent care copays were at $50. So a lot of great benefits came from switching. Now, again, when we're comparing everything, right, when we compared their 3 Blue Cross Blue Shield policies versus the 3 with UHC, again, the benefits were pretty in line, and then the premium savings was, again, pretty substantial. So how did they factor in, or how did they determine what that premium is? Well, with level funded, what they're doing is they're trying to project or forecast how much they expect to pay out in claims going forward. So when they look at your group, if they think that you're a healthy group, they're going to come in and they're going to show you guys, or show your company, a lower premium. Now, it works a little bit differently in terms of how the benefits work, right? So I'm going to break down how the premium goes. So with Horizon, right, you're paying, $11,000 a year, or I'm sorry, $11,000 a month. Now, let's just pretend hypothetically that it was the same. The premium was exactly the same. Well, with a fully insured policy, you're paying your monthly and annual premium, and again, you're lumped into their total block of business, right? So that's it. If there's any excess, right, if there's, maybe you didn't spend $81,000 that year in premium, well, that money had to offset the other groups. So maybe, so if you had paid $81,000 that year in premium, but maybe you didn't spend $81,000 in claims, right? You guys never went to the doctor. Well, again, that money stays with the carrier because now they have to offset the other groups that might have, had more claims that they paid in premium, right? Everyone is lumped together. And that's why you never know how much of the insurance, you utilize. So we saw that there's a premium savings, right? So let's break down how the premium works. Well, UHC here, they're billing $68.23 every month, or $81,000 roughly for the annual. So with level funded or self-insured, you can see exactly how that premium breaks down. So like I mentioned, they were paying $68.23 if they went with those 3 plans. and that's $81,000 per year in premium. The way that level funded works is they set aside X amount of dollars every year or in every month that you're paying your premium to cover your claims. So in this example, for this group, UHC was going to set aside roughly $29,000, $30,000 a year to pay for the claims. So when someone went to the office or doctor office for a checkup or a prescription had to get filled, they were paying for those services out of this amount. Now, throughout the year, if there's not many claims at the end of the year, the group will get half of this back. So for example, if this group signs up and they never use the insurance at all, at the end of the year, they have a chance of getting $15,000 back. So there is a reward for, again, healthier groups, right? You're getting that money back. Now, what happens if they blow through this money, right? What happens if there's $1 million worth of claims, Jeff? What happens then? Well, again, they're collecting $81,000 from the group every year. $29,000 of that is going to pay for claims. This other $52,000, that's going towards administrative fees to run the plan, and then as well as stop loss insurance. What stop loss insurance is it's insurance above this number, so that if a group does blow through this $29,440 claims fund, right, the insurance company is there to pick up everything so that the group does not have to hold the bag, right? They don't have to worry about paying that $1 million of claims. So this is a way so that if a group does have, a bad year claims-wise, okay, hey, we're covered with the stop loss, the claims fund. They pay their premiums just like they did with, or that they would have with a fully insured plan. However, if the group runs well and there's minimal claims, well, we're getting money back and then possibly a very low increase compared to fully insured, where again, you're lumped in with everyone. So with fully insured, again, even if the premium was the same, you're paying the same premium, but if there's a good year, that's not using the insurance, well, it doesn't matter. You're lumped in, so you're still getting that 10% increase, like I mentioned before in the example. You can't break down and see exactly how this $81,000 is being spent on these fully insured programs. So the level funded really peels back the onion or lifts the hood on the car and allows you to see exactly how the insurance is operating. And again, it allows you to take more control here. So when we're looking at these programs side by side, we'll tell the client, hey, not only are you going to save $50,000 this year in premium, there's a chance that you might actually get money back if the claims run well, right? And the insurance company isn't going to offer you this deal if they think that it's just going to blow up the next year, right? So a lot of times when we put our clients through this process of getting a level funded quote, sometimes the carriers will come back and they'll decline. They'll say, hey, we're not the right fit. It makes more sense for that company to stay on the fully insured side. So when a carrier does come to us with a strong offer, we know that this is a group that should be on that type of platform or that type of product, because not only will they save the $50,000 that they would have just wasted in premium otherwise, well, now they have an opportunity to control their own destiny, get money back, and maybe keep renewal increases at a low level or at bay going forward based off their group and not everyone else that's out there with that carrier. Now, I mentioned before that there's no loyalty discount with these fully insured programs. So in the event that even this plan, let's say it does blow up and it just doesn't work out after year one, they can go right back to paying whatever the rates are with Blue Cross Blue Shield or whatever fully insured program that they were at prior, because again, the rates are the rates. This premium is simply just based off of the members that are enrolled and where the company is located. So there's no loyalty discount that they're losing or anything like that. So in the event that this program doesn't work, they can always go back. Now, in terms of figuring out, okay, well, Jeff, how do we see if level funded is going to work for us? Like, who is this good for? It's really good for any groups who think that they are on the healthier side. Now, if you're really not even sure, you can get a level funded quote from most of these carriers by just having 5 or more employees enrolled. The fewer employees you have enrolled, the lower your options are, because each carrier has their own underwriting requirements. But if you do have a company that has 5, 10, 15, or 20, eligible for benefits, that's where, again, we can go to these carriers and get a quick comparison side by side compared to your fully insured options and see if it makes sense. So if you're interested in seeing what the level funded or these self-funded programs look like for your group, the best thing to do would be to reach out to us. You can go to groupbenefits.com/RFP, and that stands for request for a proposal. From there, we can get a level funded quote and see what that looks like. As mentioned, it's a great way to save money and see what other options are out there that you might not have seen yet. So we appreciate you watching and hope this was helpful. Take it easy.